U.S. stocks are on a downward slope this week, while lawmakers are wrangling over plans to raise the federal debt limit. Francois Trahan, vice chairman and chief investment strategist at Wolfe Trahan Co, joins us this hour to give us his perspective on the moves in the market. Prior to joining Wolfe Trahan, he was chief investment strategist with Bear Stearns. He's also a co-author of the new book, Era of Uncertainty. Francois, welcome back to Bottom Line. Pleasure to have you back.
Thank you.
Is the U.S. going to default?
It's hard to say. I don't think they'll default on their debt obligations. You know, the reality is that Treasury Secretary Geithner can choose to default on a lot of things, Social Security payments, I think, being at the top of the list. So I don't think they will miss any interest payments, if that's the question.
Earlier today, Joseph Balestrino of Federated Investors was on with my colleague Margaret Brennan, and he said that a U.S. credit downgrade by S&P is, in his words, very much on the table unless credible deficit reduction plans are introduced. If there is a default, as Mr. Balestrino intimated, he said, would it be seen as a political default as opposed to a mathematical default?
Well, what he said was a downgrade, not so much a default. To me, those are two very different things.
Okay.
You know, the bottom line is it's lose-lose, because if you agree, you know, there's been 6 different packages that have been proposed so far. Whichever one you agree on, you know, austerity leads to slower growth. That's the bottom line. And that's what matters for jobs. That's what matters for the stock market, for the bond market, et cetera. So there is no win-win situation here. Even if we decide to really seriously address the deficit issue, it's going to be eventually a shock to the stock market. The government's going to spend less, that's the reality, and they're probably going to tax more. That's how this is going to end. And that means slower growth, and that means lower P's for stocks.
Is the U.S. too big to fail? Is that why the bond market doesn't seem to be worried?
Yeah, that's a good question. You know, it's not just the bond market. If you look at the equity market, we're just 2% off the highs that we reached earlier this year. 10-year Treasuries around 295.
The indices are still up.
Well, I think what the stock market is telling you so far is that, you know, so far at least, it's not taking this, you know, circus in D.C. very seriously, and that they believe some sort of deal will be struck. I think that the bigger issue, the stock market started losing steam, you know, well before we ever talked about the debt ceiling. It happened earlier this year when the economy started losing steam, when leading indicators of the economy started topping out. And that happened for other reasons, in my opinion. So we have a lot of issues taking place. I think the debt ceiling is just one of them.
Francois, economic news today. Fewer Americans buying new homes in June. Commerce Department saying that sales fell 1% last month. That annual rate about 312,000. In a healthy economy, that rate's about what? About 700,000. How long is housing going to remain the weakest part of this economy?
I think as long as we choose, you know, short-term recipes to try to boost the economy. Listen, this was predictable. The bottom line is where you have a glut of unsold properties is in low-income and middle-income homes. And the Fed, with this policy, QE2, what they've done is they've basically squeezed the disposable income of those folks. Because QE2 weakened the U.S. dollar tremendously, so you're asking all the low-income and middle-income folks to pay more for gasoline, for clothing, for food, for heating oil. They have less money left. Of course, home prices are going to start to go down again. This was predictable. This was foreseeable. This is absolutely the wrong policy.
And my colleague Michael McKee wanted to jump in as well. Mike?
Yeah, well, let me run through a couple of the numbers as a prelude to a question here for Francois. We start with consumer confidence, which actually rose after the Michigan sentiment numbers plunged. Consumer confidence from the Conference Board actually rose last month to 59.5, a little bit higher than people were expecting. And the odd part was more people saw more jobs ahead. This number influenced by the jobs numbers quite a bit. People think that hiring is going to pick up. You mentioned the home sales numbers. Also, the Case-Shiller index out today. Prices on a month-to-month basis also rose. So you have this real mixed picture going on. And I guess my question is the economy in a soft patch, coming out of a soft patch? Independent of what's going on in Washington, where are we?
Yeah, well, those are very, there's numbers that are very, impacted by seasonal factors. And you could see it, your series said non-seasonally adjusted. So if you look at them on a year-over-year basis, I think they're going to give you a different story. Regarding consumer confidence, you can also look at consumer confidence by income bracket. I doubt that you're going to see that low and middle income consumer confidence is improving. I think that's going to be under pressure for a long time. The U.S. dollar going lower is weighing heavily on that segment of the population.
Well, one other quick question, and that is, where does the Fed fit into all of this going forward? Because you've got slow growth, certainly, but inflation seems to be picking up. Just today, Domino's put out their commodity price index, the things that go into making pizzas, up 5% in the second quarter, and they think it's going to be even faster the rest of the year.
Yeah, and Walmart had warned us about higher inflation already many months ago. You know, let me ask you this. You do a policy called QE1, it doesn't work, and you do QE2 and it doesn't work. You know, do you go and try it a third time? I think at some point you got to take a step back, you know, and see if it does do anything at all to support the economy. My sense is when the Fed funds rate's at zero, there's not a whole lot that the Fed can do that is not counterproductive.
But as you know, Francois, you know, Chairman Bernanke, members of the Fed saying there were exigent circumstances. They didn't have a choice. They had to do this because the economy was suffering.
Well, yeah, the economy continues to suffer. You know, they had a choice. They followed their mandate. The unemployment rate was moving higher. Core CPI was moving lower, which is their mandate. You know, it's a different story this year. The unemployment rate, I think, is going to tick higher the rest of the year. The problem.
By about how much?
Well, who knows? But my sense is it will be in double-digit territory at some point in the next 12 months. You know, the problem for the Fed is what do they do when core inflation is now accelerating? If they follow their mandate, there's nothing they can do. I think they're just going to have to watch the data points deteriorate.
I'm curious if you're on the long list of investors who have said that they like technology here and that they expect earnings to continue to outperform and drive the stocks higher.
No, actually, it's one of the sectors that we like the least. You know, tech earnings, tech's done well in the last month, no doubt on that, but it underperformed the S&P significantly this year. You know, it's the PE that's really hurt tech companies, which is the same story as the S&P. The PE has been coming down at the same time as earnings have been going up. I would tell you what really worries me is what happens in the back half of the year if PEs continue to compress at a time when earnings estimates start to slip. Obviously, that's a bad combination for stock prices overall. So tech, in my mind, one of the sectors that is the most levered to the business cycle, so not a sector that I would own at this point.
What about the more consumer-oriented tech companies? I mean, you know, it's tough to lump tech into one big industry altogether when you have some companies that are much more corporate dependent. I think of Lexmark today, which is outperforming on its earnings. And then, of course, you have an Apple, which has been continuing to do very well and only trades at around 15 times this year's earnings.
Yeah, well, and you'll have different levels of sensitivity to the business cycle as well, even within technology. You know, you look at semiconductors companies, obviously that's a perfect proxy of the business cycle. So as soon as growth prospects begin to slip, you know, you see it in semiconductor stocks almost immediately. And that's been one of the worst performing sectors this year. So in my mind, that would be the types of stocks that I would really shy away from. You know, when it comes to services, companies that have more predictable revenue streams, I think you can find stuff there that's going to, you know, do well and outperform the S&P probably. But overall, to me, tech, a sector that's not interesting, you know, in a year where we're going to price in slower growth, not better growth.
My colleague Sheila Dharmarajan also standing by with a question. Sheila?
Yeah, you know, speaking of outperformance, one group that has certainly had a lot of outperformance this year is healthcare stocks. In fact, right now it is the second biggest winner in the S&P year to date, up about 11%. So massively outperforming the S&P. Certainly this defensive trade has been very popular with investors, you know, with all the uncertainty in the markets right now. Francois, my question to you is, given such a performance with healthcare stocks right now, do you see that there's continued room for those stocks to grow? If so, what is the catalyst? Is there a certain M&A catalyst? Is it really a waiting for the dividends play? Is it a defensive play? Just wanted to get some more sense on why you like healthcare so much.
Yeah, it's the opposite of tech, you know, so I think the catalyst is slower growth. Ironically, you know, the relative performance of healthcare looks like the opposite of technology. So you price in slower growth, people tend to flock towards stocks that offer stability, and where they find that is in healthcare companies, not in semiconductor companies. If you lose your job, you're still going to, you know, buy Lipitor and brush your teeth with toothpaste. You're not going to necessarily buy a new iPad. So to me, it makes sense that healthcare is outperforming. I would tell you it's not a great sign of things to come for GDP. So staples, utilities, all in the same boat. All three sectors are outperforming this year.
Francois, do you get any sense that this time around that might be a little bit different in the fact that healthcare is not continuing to grow? We're starting to get some evidence of that. Yesterday, for example, HCA, one of the largest hospital chains out there, said that people were actually cutting back on surgeries because of the economy, because of unemployment, because they didn't have insurance. Is there perhaps a different tune to healthcare being a defensive play this time around?
Yeah, you know what a lot of folks say to me sometimes is that they use technology and they say technology is a lot less cyclical than it used to be. I think it used to be 80 times more cyclical than healthcare. healthcare, it's now only 60 times more cyclical than healthcare. So I think the point is fair, but the reality is you have much more predictable revenue streams in healthcare companies than you ever will in technology, as I see it.
Francois, I'm watching a couple of the multinationals and really paying attention to what the CEOs and the CFOs said today. The CEO of 3M, George Buckley, very worried about the economy, the world economy. We have Ford CFO Louis Booth saying it wasn't the easiest of quarters. There's weaker demand in North America and Europe. And then the UPS CEO, which we covered a couple of minutes ago, saying the U.S. is extremely sluggish. These stocks are down today. When you hear these kind of comments from these big multinationals, and last week, as you know, Caterpillar cut its global economic growth forecast by about 0.5%. What does that tell you?
Tells you you should build cash positions. It tells you it's probably time to take some money off the table here. In my mind, that makes sense. You just covered, bellwethers that really have far-reaching, tentacles when it comes to what's happening to the global economy. So obviously, it's a big warning sign.
Francois, if I might ask, you say take that money off the table. Take it where?
Well, there's, if you believe we're going to come to some sort of agreement on the debt ceiling front, take it to treasuries, or take it to cash, or you can also buy cash and bonds in other currencies, since the U.S. dollar has been very, very weak. So there are places to hide, if you will, at this time, or put it in high-yielding stocks. There's a lot of ways to reduce your exposure to the market. It doesn't necessarily mean that you need to sell everything and move everything to cash, but I would definitely reduce my beta in my portfolio or reduce my risk level in my portfolio.
I actually have a bottom line. You wrote a book. We mentioned it, Era of Uncertainty. Why did you write it?
I would say the impetus behind it was QE2. So last summer, when Chairman Bernanke first started talking about QE2, I felt that was a bad road to take for the U.S. And I think a lot of folks at the Fed have the equation wrong. I think we have an economy that is allergic to higher inflation. So to hear the chairman of the Fed say that inflation is a desired outcome, that somehow we're going to inflate our way out of this, to me is absolutely wrong. I would say initially that was the impetus behind the book.
So, as far as you know, we actually had a brief discussion before, there's not going to be a QE3, no matter if there's a debt ceiling limit reached or not.
Well, I think a lot of the folks at the Fed now get it. They've seen what inflation is doing to the economy. We're staring at a downturn. It's not just the U.S. The world economy is staring at a downturn. So this has done more damage than good. It's led to a much lower dollar. It's helped exports, a tiny little share of our economy, 12%, but it's hurt consumption, which is 71%. Anybody can do the math. Yeah. It's pretty simple. It's sending us into a downturn. So to me, QE2 is sending us into a global slowdown.
Francois, we have a minute left. I'd like to get your bottom line on what this U.S. economy looks like going forward. What are your metrics? What are the indications between now and the end of the year?
Well, I don't think it's going to be pretty. Leading indicators of the economy are already beginning to slide, and I think that's going to become more pronounced, irrespective of what happens with the debt deal. That's just adding to the story. And really, what is sending us into this downturn, the real irony, I believe, is higher inflation, i.e. QE2. So the Fed, I think, has made one of the biggest blunders, in 20 years with this policy. So the bottom line is we're staring at a much slower economy. You need to protect your portfolio from slower growth. You can do that. We talked about counter-cyclicals earlier. Yeah. Healthcare, staples, utilities. You can do it, by investing in those sectors or taking some money off the table.
Francois Trahan, Vice Chairman, Chief Investment Strategist, Wolfe Trahan Co, joining us from the hour. It's always a pleasure to have you on, my friend. Thank you so much.